The U.S. economy grew by 3.2% in the first quarter of 2019, more than twice the 1.5% consensus growth rate expected by economists surveyed just 3 weeks ago. The surprising strength immediately set off speculation about whether the strong growth was sustainable. Headlines were skeptical that strong conditions would continue, but the press glossed over an important emerging trend. According to independent economist Fritz Meyer, whose research we license to share with our clients and friends, the economic strength is partly attributable to an emerging trend in government spending. Over the last few years, state and local government spending has slowly climbed back to normal following the Great Recession and grew 1.8% in the 12 months ended March 31st. But because states and municipalities made such deep cuts from mid-2009 to late 2011, this trend has staying power. The surges in state and local government spending boost the economy, but only show up in the GDP figures when states and localities spend money and not when they issue bonds, which makes this trend hard to detect. According to Meyer, who was a senior strategist at one of the world's largest investment companies for over a decade before becoming an independent financial economist who is not tied to any financial products. Meanwhile, the private sector, the main engine of U.S. economic growth, has accelerated. From the fourth quarter of 2009 to March 31, 2019, the compound average growth rate of the private sector was 2.9%, much better than the 2.5% at the peak of the last economic expansion. Moreover, private sector growth in the 12 months ended March 31st came in at 3.6%, so it's accelerating. With private sector growth accelerating, the increase in state and local government in the background is boosting a key fundamental factor in U.S. economic growth.